Good morning and welcome to the Friday Financial Review. I'm Paul Griffiths. I'm a financial planner for Europe. So welcome to another wonderful week. We're getting to the second half of June here in sunny Spain. And today we will be discussing, or should we say continuing, our mini-series on Portugal. So this is the second part. Last week we briefly touched upon the non-habitual residence regime in Portugal. Today, we're going to cover off general tax information surrounding investments and pensions. These areas are, of course, our core areas as a financial advice firm, and of course, many of our clients, it really affects them greatly, and for them to better understand what their obligations are and what taxes might be due. So, let's begin with investment. Now, just to keep it simple, today when we say investments, we are going to be referring to shares, so stocks and shares, or equities, funds, unit trusts, investment trusts. So really these are what we call liquid form of investments, and clients would have purchased these or invest in these either directly buying shares from a company or via their online brokerage platform, or perhaps a lot of you might have purchased or invested via your ISAs, so using up your annual ISA allowances if you're from the UK or have lived in the UK. Now, in general terms, the income generated from these investments, so dividends from shares, income distributions from a lot of the investment funds that are available, and as well as dividends from unit investment trusts and other forms. These are not exempt in Portugal for taxation. They are taxed at a rate of 28%, or depending on your own personal income tax situation, you can opt to simply add them to your annual Portuguese tax return and pay a progressive rate of tax starting from 14.5% and all the way through to top rate at 48%. So really it is about looking at one situation and see which option is going to be the best. The great thing is you're not fixed with one option, so if 1 year is better to go down the 28% route, then do so. If another year you've got very low income and you're better off going on the normal income tax return route, then off you go. Now, the 28% also applies to certainly capital gains on those investments. What do I mean? Well, when you sell a share, when you sell a fund, you're realizing either a gain or a loss, or perhaps even just break even. So, of course, in the event of a gain, those capital gains need to be declared and paid in Portugal as well. Again, the rate of 28%. Now, I know what you're saying. For those who perhaps feel that under their non-habitual residence regime that they would not be applicable, or these rules do not apply for the 10-year period. Well, this is an area of contention because under the actual technical rules of the NHR regime, the wording does stipulate that passive income, so that's dividends, income from funds, are exempt from Portuguese tax under the NHR regime as long as there is an existing double taxation agreement or the income, the passive income is coming from a country member of the OECD, but more importantly, that these income would have already been taxed at source. So this is all about the double taxation. It's to ensure that you're not taxed twice. It's to ensure you pay the right amount of tax. Okay. So the NHR regime is quite loose in that to say that as long as it's been taxed in the country at source where your account is, then technically speaking, you'll be exempt from paying taxes during that 10-year NHR. Well, a lot of people from NHR, they think that they're fully exempt, especially if you are holding assets like investments within an ISA, which is tax-free, of course. Well, when you sell things in an ISA, the UK is not going to tax you, which means it's not taxed at source, which technically means you might, or you will, have to pay taxes in Portugal accordingly. Depending which advisor you speak to, depending which tax man you speak to, you're going to get two different answers, unfortunately. One will say you're fine, no problems. One will say, like me, you're technically obliged. Those that say, no, you don't have to pay any tax, none of them will ever sign their name to that. They'll always put a caveat in there saying, especially accountants saying, this is our interpretation and we could be wrong, basically. Even the big boys, you know, the big four, the PwC, KPMG, Ernst & Young, and what's the other one? UA. So even the big four will not put a black and white rule on it because they themselves have to keep some form of backdoors. So when I speak to people with NHR, I say to them, look, if you have ISAs, you've got investments in other countries, and you're not declaring them in Portugal, look first if they're being taxed at source when those incomes are paid, when those capital gains are raised. If they are, brilliant, happy days. You shouldn't have a liability in Portugal. If they're tax-free, though, from where they are, then the chances are you really, really ought to declare your taxes here in Portugal. Now, what I'll do is I'll come back to the matters of NHR in terms of do you, don't you, in just a second. What we'll do now is simply just move on to pensions in general, okay? In Portugal, there's no concept of what we call the personal allowance on your earnings. You do get it, but it's via a series of tax credits and incentives, which can vary from year to year, okay? So from a pension perspective, after my last discussion with our accountants in Portugal, as an average, a pensioner would receive perhaps between 4, maybe at best no more than €5,000 of various credits and incentives. That would mean that that amount is tax-free or tax-exempt for Portugal. This is your personal allowance. Therefore, anything above that is going to be taxed in Portugal, or certainly you have to file your return in Portugal accordingly. Thankfully, Portugal, like a number of other countries, if you worked for the governments where you were in the UK, France, or wherever, you work for a government department, so what we call civil service, 9 times out of 10, those civil service pension benefits will not be taxed again in Portugal. It will be the home state, the UK, for example, that has full taxation rights and keeps it. However, for those with company schemes, private schemes, especially from the UK, HMRC will determine if taxes are deducted at source when those benefits are paid. You then do your annual return to the Portuguese, and if it's deemed that you've got to pay a bit more, because obviously due to the lack of personal allowances, then you pay the difference in Portugal. So you're not taxed double, you pay the difference, okay? The tax rate, again, works on the standard progressive earned income tax rates, 14.5%, I think, for the first €7,000, and then it goes up all the way up as high as 48%, okay? So yes, pension income, very careful, you've got to look at it properly, okay? Now, just like the investments, there is a special regime for those on the NHR regime when it comes to their pension income. We touched upon it last week, and it is a flat rate of 10% whilst you're under NHR. Now, you've got to look at it properly. If it's taxed in a country at source like the UK, you've got to work out what the bandings are, okay? If you take only 30 grand a year, you've got to work out have you paid more than 3 grand in taxes to the UK. If so, then you're not going to pay any more in Portugal, because Portugal caps it out at 10%. So that's a very crude example, okay? So yes, that's what the NHR is certainly pointed at in terms of high-skilled workers and those retire or retiring to come to Portugal. Now, we just briefly sort of talked about do we, don't we, on your investments in terms of declaration. Again, from the various conversations I have with accountants and whatnot, it is a view or an opinion, shall we say, and we have to stick with opinion. There's nothing black and white. NHR itself is relatively a new regime by its own right. Yeah, it's not been around for too long. So, and the government, shall we say, I'm sure they'll catch up very soon, but they're very slow in the uptake in terms of do we take a deep dive into individuals' NHR status. Are these people declaring their assets overseas? Now, we all know that with the common reporting standard that came in 2017, the information is being shared. But like most governments around the world, they lack manpower, although things are getting hotter. So for those of you listening to this video, watching this video, who, under NHR, or even those who are not under NHR, but have investments in their other countries, you really, really got to make sure you do it right. If you're already doing it right by declaring, brilliant, happy days. If you're not, then speak with me, speak with your own advisor if you have one, speak to your local accountant and get advice. Very, very important, because there are things that can be done to better improve your overall situation. And that's what we're going to be talking about next week, is about what can one do, how to make it easier, how to make it simpler now that you're living in Portugal. So that is us for today in our part 2 on Portugal taxes. I want to thank my viewers, I want to thank my followers on YouTube, Facebook. I've got my own TikTok now as a financial chef. So it's Financial Chef 168, it's my TikTok. If you want to watch me cooking, then by all means go on to that. And yeah, just want to say a big thank you. Big thank you for continued your support with me. Anything new, any other different type of content you want me to talk about, do message me. I'm very much open for suggestions. So until next week, you guys have a wonderful Friday. On Monday, I'm having my jab, so that's great. And yeah, have a wonderful weekend. Bye-bye.